these Reddit lists every day as far as what you're buying and selling. You can't hide. You took your training wheels off the day you were born.
Yeah, Hi, I'm Ren Leggi, Client Portfolio Manager at ARK Invest. On this season of The Switch, we're going to address the mechanics of exchange-traded funds. As always, we'll be joined with ETF Trends to facilitate the discussion and make sure we don't leave anything unanswered. So let's get the conversation started with ETFs versus mutual funds and active versus passive ETFs.
Hey, Ren, just to get going, you folks at ARK offer mutual funds, you offer separate accounts, you offer ETFs. As you look at those different structures, how do you embrace that as a whole, especially as you think about your clients?
We offer a wide range of vehicle types for our clients. We have clients that are, start very small at the retail end, high net worth, leading up into, endowments, foundation, pension funds, even sovereign wealth funds. And so each vehicle has its advantages and disadvantages, and some make more sense for some clients over others. What we've seen is, a lot of demand for our actively managed ETFs.
So, I think the three things I always highlight about the ETF structure that I think has drawn a lot of folks to the structure are tax efficiency, transparency, and liquidity. And those really are unique to the ETF structure. Is one of those, do you think, most advantageous to the sort of innovation-seeking investor who's looking at your strategies?
So I think all of them are very important factors. Taxation, because we do trade fairly often, and sometimes we can realize gains and we can offset that over a tax year, right? And the ETF wrapper allows us to be more tax efficient than say other wrappers. But also, I think the one kind of benefit or advantage of ETFs that less people talk about is really liquidity. And how, from a portfolio manager's perspective, how liquidity, isn't kind of an area of concern because it's handled by third parties.
So Dave, Ren talked a little bit about advantages. You talked about advantages in ETFs. There's $6 trillion in ETFs right now. I mean, most of that money being in passive. We see an active strategy here, an active strategy that ARK has. What would you see are some of the biggest advantages when you look at ARK and their structure?
Well, I'm a big fan of transparency, right? I mean, I came up through the passive world, but I love active managers who are really willing to put it all out there. I think there's something to be said for not only talking your book, but showing it over and over again why you're doing something when you're doing it. So the inherent transparency of ETFs, to run a truly active ETF, you almost have to use a fully transparent model like this. And I think that that's great because it really helps investors know what they own. I think we have to remember most investors aren't going to own one fund, right? An investment in ARK or an investment in any other ETF is going to sit alongside other investments. And that means you really need to know what you own, right? If I'm sitting in an ARK fund that has a significant position in Tesla, say, I need to know that because I may also have some index strategy that has a bunch of Tesla, or maybe a tech fund I'm looking at that has a bunch of Tesla. And if you can't look at those overlaps, it's really hard to run a portfolio. Ren, I'd love to get your thoughts on this. You guys, again, but you run both active and passive strategies here. What do you think the advantages of one versus the other are when we're comparing alternatives in the space? Why not take, say, the ARK, flagship fund, ARKK, and just make an index out of it?
So, I mean, that active approach is so important, right? We can move, we can be very nimble. We're never forced to buy anything. We're never forced to sell anything. And that's the beauty of active management, right? Now, when you wrap that in an ETF, it makes it a lot easier, right? To from a portfolio management perspective, in that you don't have to worry about all the other mechanics and sometimes extra cost. So there's a lot of advantages there. What we've seen is that a lot of investors have started to demand actively managed ETFs, right? And we've seen kind of an increase. I think that could be correlated. I don't know, Dave, if you're seeing the same thing on your end. We've seen a surge in thematic ETFs, right? And many of them are starting to become active. And ARK has led that kind of charge. But it seems to us that investors are starting to demand innovation-focused, actively managed ETFs. So we think this is part of a trend.
Hey, just throwing something else in there. When you talk about active versus passive, we've all seen the SPIVA studies put out by S&P, and really the ability to consistently outperform the markets is almost impossible on a regular basis. Some companies that have done that for short periods of time end up moving to the bottom, but you folks continue to put up great numbers. What does that mean to the future of active management, especially as the way you folks look at it? And most importantly, when you do that transparency overlay, Dave and I kind of giggle sometimes where some of these underperforming fund companies are so protective of their knowledge and their IP as far as what they're buying and selling, when in fact they're underperforming.
I think we're very unique in the asset management, not only in the asset management industry, but also in the active world. A lot of managers kind of start with the benchmark, right? And they manage to that benchmark, and their goal is to outperform the benchmark. And so you'll see a lot of overlap between their actively managed fund and the benchmark. In our case, we're not managing to a benchmark. We're completely agnostic. We're focused on innovation, and that is global in nature. It cuts across market caps. It cuts across sectors. So when you look at some of our ETFs versus some of these broader-based indices, even if you look at it versus the S&P technology sector, we have extremely low overlap. So that positions us to be able to outperform in certain environments versus when you look at some of these other strategies that in some cases a lot of them are closet indexers, right? They're just enhanced indices at the and when you add in layers of fees, sometimes they'll underperform or they'll be very close. We're providing forward-looking exposure to these massive opportunities. So we're unique in that respect. We're not trying to provide or overlap with kind of investors' core portfolios, and many of which may be more passive, right? We're looking for the next group of FANG stocks, and we want to be positioned to benefit from that over the next 5-10 years.
It's almost a different kind of transparency, right? If you're going to be passive, stick to that benchmark. If you're going to be active, actually be active, right?
Yeah, they're active. They're like naked way up on top of the mountain where everybody can see. I mean, these Reddit lists every day as far as what you're buying and selling. You can't hide. You took your training wheels off the day you were born.
Yeah, Thanks, Tom and Dave. As always, it's been fun. I'll see you on the next episode of The Switch.